Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're delving into the recently released 2025 Housing Market Outlook from the Canada Mortgage and Housing Corporation, commonly known as CMHC. As we navigate through a period of significant economic uncertainty, largely driven by changes in trade policies from the United States, the Canadian housing market is expected to face some serious challenges. The CMHC's outlook provides a forward-looking analysis into the national and major housing markets across Canada for the years 2025 through 2027. Interestingly, this year's outlook does not settle on a single base case scenario. Instead, it presents three plausible scenarios, each detailing how the housing market could be impacted throughout the forecast period. This approach reflects the complexities and uncertainties in the current economic landscape. The CMHC has committed to keeping a close eye on these evolving conditions and will update its forecasts as necessary. For those interested in a deeper dive, you can watch a detailed breakdown of the 2025 Housing Market Outlook on CMHC's YouTube channel or read the full report on their website. At the end of this month, CMHC is set to release more detailed forecasts for the housing markets in Canada's major cities. This will be crucial for those of us keeping a close eye on urban real estate trends. You can also follow CMHC on various social media platforms, including X, formerly known as Twitter, YouTube, LinkedIn, Facebook, and Instagram, to stay up to date with their latest insights and updates. Moving on to the Toronto Regional Real Estate Board's TRREB 2025 Outlook, the board has projected that the Greater Toronto Area, GTA, could experience buyer's market conditions. This comes as a notable shift from the seller's market that has characterized the area for several years. According to the report, the factors contributing to this change include a combination of increased housing supply and a more moderate pace of home price growth. The TRREB's analysis points to a confluence of economic forces that are expected to influence the market dynamics in the GTA. Among these forces, the potential impact of rising interest rates and ongoing economic uncertainty are highlighted. The board suggests that these factors may lead to a more cautious approach among potential homebuyers, who might wait to see how these elements play out before making purchasing decisions. Additionally, the TRREB report emphasizes the importance of government policies in shaping the housing market landscape. The introduction of new regulations or changes to existing policies could further impact market conditions, either by encouraging more housing development or by affecting affordability and accessibility for prospective buyers. While the outlook suggests a shift towards a buyer's market, it's important to note that these projections are contingent on various economic and policy developments. Therefore, it's crucial for stakeholders, including buyers, sellers, and investors, to stay informed about ongoing trends and forecasts to make strategic decisions. For those interested in exploring the full details of the TRREB's 2025 Outlook, you can access the report through their official website. Staying updated with these insights can provide valuable perspectives for anyone involved in the GTA's real estate market. In recent economic news, former Bank of Canada Governor Stephen Poloz has issued a warning regarding Canada's economic resilience in the face of potential new tariffs from the United States. During an interview with BNN Bloomberg, Poloz, who now serves as a special advisor at Osler, expressed concerns about the ongoing trade tensions between Canada and the United States, which have created a cautious investment climate north of the border. Poloz highlighted that businesses in Canada are hesitant to invest due to the prevailing uncertainty, which is contributing to a weakened economic backdrop. He described the current state of Canada's economy as fragile, having been in a weak spot for nearly 2 years. Poloz further noted that the underlying economic issues have been somewhat obscured by high immigration flows, which tend to mask the data. According to Poloz, household spending in Canada is declining on a per capita basis, and with mortgage renewals on the horizon, the outlook appears bleak. He drew parallels to the period during Donald Trump's first term as U.S. president, when uncertainty prompted Canadian investment to shift southward in search of more favorable business conditions. Polos pointed out a stark contrast between the sluggish investment climate in Canada and the economic momentum observed in the United States. He attributed the U.S. economic strength to tax incentives introduced under President Joe Biden, which have spurred business investment and boosted productivity. They have an actual investment boom going there, supporting growth, Polos explained, emphasizing that the U.S. BUFCY's deficit is largely due to increased investment rather than mere fiscal giveaways. By comparison, Polos criticized Canada's approach as being overly cautious, with a wait-and-see attitude that has discouraged businesses from making long-term investment commitments. He suggested that Canadian government fiscal policies have been too focused on household support, rather than stimulating business investment. Reflecting on Canada's pre-pandemic economic condition, Polos remarked that the country was in a much stronger position back then, with unemployment at a 40-year low and inflation right on target. He expressed concern that Canada might be less resilient to economic shocks now than it was at that time. The looming threat of United States tariffs is casting a chill over Toronto's spring housing market, with experts suggesting it might lead prospective homebuyers to reconsider their plans. Even though United States President Donald Trump's tariffs on Canada are paused for 30 days, the possibility of these tariffs taking effect at any time has a psychological impact on buyers, leading many to delay or even shelve their purchase plans. The proposed 25% tariffs, which were set to begin before a last-minute reprieve, could push Canada into a recession. This could result in job losses and drive up inflation, creating further uncertainty in the housing market. Victor Tran, a mortgage and real estate expert at Rates.ca, noted that this uncertainty is likely to slow the housing market even more. He emphasized that many potential homebuyers may need to reassess their purchasing timelines and their ability to manage large debt loads during tough economic times. For first-time homebuyers, the situation is particularly precarious. With the potential for home prices to drop, these buyers could find themselves in negative equity, where they owe more on their homes than they are worth. Tran highlighted that first-time buyers, especially those barely meeting mortgage qualifications, could face significant financial risks if home prices decrease. Toronto's average home price has corrected since its peak in February 2022, but remains 14.5% higher than in February 2020, just before the pandemic lockdowns. Tony Stillo, Director of Canada Economics at Oxford Economics, pointed out that prices are still overvalued and have room to fall. If the tariffs proceed and persist for several months, the resulting unemployment rise could increase mortgage defaults, further pushing home prices down. Robert Kavcic, Director and Senior Economist at BMO Capital Markets, suggested that if the tariffs are implemented and the central bank follows with an aggressive rate cut cycle, it indicates economic distress. This would likely lead to increased unemployment and more distressed home sales. Kavcic explained that only when unemployment decreases and economic conditions improve can the housing market recover. Penelope Graham, a mortgage expert at ratehub.ca, explained that even rock-bottom interest rates might not boost housing demand if Canadians face recession-related challenges such as job losses. However, she noted that significant fiscal support from the federal government and borrowing costs falling below 2% could potentially lead to a heated housing market, similar to what occurred during the pandemic when low rates drove buyer urgency. Toronto home sales experienced a notable increase in January, with a 10% rise compared to the previous month. This uptick is attributed to buyers taking advantage of cheaper mortgage rates. However, the Toronto Regional Real Estate Board, TRREB, has expressed concerns that potential trade disruptions could dampen the momentum in the housing market throughout the year. Despite these concerns, TRREB remains optimistic, predicting that this year's sales will be 12.4% higher than those in 2024, a year when high borrowing costs pose challenges for buyers seeking mortgages. The Bank of Canada has played a significant role in this shift, having cut interest rates 6 times since June, bringing the average 5-year fixed mortgage rate down to just over 4%, compared to approximately 5% a year earlier. Jason Mercer, TRREB's chief market analyst, highlighted the potential positive impact of lower borrowing costs on home buying activity. However, he cautioned that this positive trend could be temporarily offset by the negative effects of trade disruptions on the economy and consumer confidence. The full impact of the United States tariff risk on buyer sentiment remains to be seen. Recently, the country faced the prospect of 25% tariffs on most Canadian goods, which were initially set to begin but were postponed for 30 days by United States President Donald Trump. Prior to this announcement, home sales had been on an upward trajectory. In January, the Toronto region saw 5,971 home sales, marking a 10% increase from December, according to TRREB. Additionally, there was a surge in new listings, with homeowners putting more properties up for sale, resulting in a 26% increase in new listings from December to January. Home prices remained relatively stable month over month, with the typical home price at $1,089,300. Home buying intentions have stayed consistent with last year, as indicated by a TRREB Commission survey, which found that 28% of respondents were likely to purchase a home in 2025. TRREB forecasts a 2.6% increase in average home prices this year, with more significant price hikes anticipated for houses compared to condominiums. The board suggests that lower borrowing costs, combined with ample supply, will enhance affordability and encourage more buyers to make purchasing decisions. However, the looming threats to the domestic economy could introduce uncertainty. Victor Tran, a mortgage and real estate expert with Rights.ca, noted that the natural inclination for many people might be to exercise caution and refrain from making substantial purchases during uncertain times. A new report highlights a significant shift in Canada's housing market, with millennials emerging as the most influential group of homebuyers. Defined as individuals born between 1981 and 1996, millennials are now reaching key life stages, such as forming partnerships, starting families, and raising school-aged children, according to a report from real estate brokerage Zoocasa. Millennials account for the largest share of home buyers, with 56% of buyers aged 25 to 34 and 30% of those aged 35 to 44 actively purchasing homes, as reported by the Canadian Mortgage and Housing Corporation in its 2024 report. Recent federal policy changes have made homeownership more accessible, particularly for millennials and Generation Z individuals looking to enter the housing market, Zoocasa noted. As of December 2024, the insured mortgage price cap increased from $1 million to $1.5 million, allowing more home buyers to qualify for mortgage insurance on higher-priced homes. For context, the average price for all home types in the Greater Toronto Area stood at $1,067,186 in December, with detached homes often exceeding $1.2 million. Previously, home buyers needed a minimum 20% down payment for homes priced above $1 million to qualify for mortgage insurance. With the higher cap, homes up to $1.5 million now qualify, requiring down payments of at least 5% on the first $500,000 and 10% on the portion between $500,000 and $1.5 million. This change significantly reduces the upfront financial burden for potential buyers. For example, a $1.4 million home previously required a $280,000 down payment. With the new insured cap, the required down payment is reduced to $115,000, saving buyers $165,000. This makes homeownership more accessible to those unable to save a full 20% down payment, particularly in the Greater Toronto Area, where buyers need about $135,000 less to enter the market, as Zoocasa pointed out. The report also notes that millennials are more tolerant of larger mortgages compared to previous generations. With lower down payments, many are willing to stretch their budgets to afford pricier homes, viewing this trade-off as worthwhile to enter the market sooner. In 2019, the median mortgage debt for millennials was $218,000, over 2.5 times their after-tax income of $83,200. In contrast, young baby boomers carried far less debt, with a median mortgage of $67,800, roughly equal to their after-tax income. Most millennial and first-time home buyers in Ontario prefer detached and semi-detached homes over condominiums. Now there's more flexibility to afford higher-priced homes or consider properties that were previously out of reach, according to the report. Despite growing concerns over affordability, millennials remain committed to home ownership. A 2024 Scotiabank poll found that 58% of millennials and Generation Z plan to buy a home within the next 5 years. Although 82% of millennials acknowledge that homeownership is becoming increasingly difficult, they still view it as a crucial long-term investment. Zoocasa believes that millennials will continue to shape the real estate market in 2025 and beyond. With shifting financial priorities, policy changes, and evolving affordability dynamics, millennials are significantly influencing Canada's housing market. As they pursue homeownership as a path to financial stability, their demand for space, investment potential, and long-term security will shape the future of real estate for years to come. In Waterloo region, homebuyers are finding themselves with more choices than ever before, thanks to a substantial increase in the number of active listings. The Cornerstone Association of Realtors, a prominent group in the area, has reported that the housing market is showing promising dynamics as we move into 2025. Crystal Mora, a spokesperson for Cornerstone Waterloo region, highlighted that there are nearly 50% more active listings compared to last January, with inventory levels well above the 10-year average. This situation is providing prospective buyers with a more balanced market environment between buyers and sellers. However, despite the increased availability of homes, the number of properties actually exchanging hands has decreased. Over 300 homes were sold in Waterloo region this past January, which represents a 12% decline compared to the same time last year. Over a longer period, this marks an 18.6% drop in January sales over the past decade. This decline in transactions is most pronounced in the condominium market, which saw a year-over-year sales decrease of 30.4%. The average sale price for a new home in the region is approximately $755,859. This figure reflects the ongoing challenges in affordability that many buyers face, despite the increased choice in the market. The data suggests that while there are more homes to choose from, economic factors such as potential interest rate hikes and general economic uncertainty may be causing buyers to hesitate. The situation in Waterloo region could be indicative of broader trends in the Canadian housing market, where increased inventory is not necessarily translating into higher sales volumes. As buyers navigate these conditions, they may find themselves weighing the benefits of more options against the backdrop of economic concerns and financial constraints. As always, staying informed about the latest market trends and economic forecasts is crucial for anyone looking to buy or sell in today's market. Understanding the dynamics at play can help you make more strategic decisions regarding your real estate investments. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.